Hello, everyone, and welcome to the NASDAQ Dorsey Red Monday Analyst Discussion. My name is Ian Saunders, and joining me here this week is Will Gibson on this Monday, June 29th. Last Monday video that we'll be doing here for the month of June, and therefore as well, also the last Monday video for the first half of 2020. So it's definitely been a pretty interesting first half of the year, and one of the more interesting first halves that we've experienced, at least in the past several years. And coming in here this morning on this Monday after we saw most major domestic equity indices posting losses there last week, coming into a further continuation of volatility, or rather some further uncertainty that we're seeing here on this Monday. Many major domestic equity indices started off the morning a little bit mixed. Some started off strong, fell off, and now we see pretty consistent broad-based rallies across the board for most of those major indices. And one in particular that we've been looking at is, of course, the S&P 500, ticker SPX, here on the platform. And the chart that we've been continuing to monitor here on this end is that 20-point chart of the S&P 500. In order to navigate over to that chart, you can see on the left-hand side of the page, you can just click on that 20, and it'll bring up the chart that should look pretty similar to the one that you see here in front of you. And you'll notice that over the past week, we've seen that further follow through the downside did result in a reversal down into a column of O's on this 20-point chart, moving from that 3140 double top formation down to a sell signal there last week at 3060. And then over the past few days, got a little bit more follow through to the downside, resulting actually with trading this morning with the S&P breaking just south of that 3,000 level at 2999 and change, I believe, to print us that O there that you see on this chart at that 3,000 point. And so when we're taking a look at this chart, we'll notice, I mean, we have still pretty consistent support that's coming in right at that 3,000 to 2980 level. So the further support from here would be one box lower from where we're going to sit after trading today at that 2980 point. We note that we have overhead resistance as well, coming again back up top of that 3140 point. So it definitely seems like domestic equity, major domestic equity indices, at least definitely on this chart here of the S&P, is going through a time kind of finding out which way it's going to move from here. So we would definitely look towards, I mean, a further sign of weakness would really be breaking out of this trading kind of band that we've been in here, south of that 2980 point down to 2960. And then that further follow through the upside would be, again, moving back to a buy signal potentially occurring there at 3160, trying to creep back towards those highs that we reached at the beginning of the month at the 3220 point on this chart. But there's definitely been some interesting movement that we've seen in some of the underlying indicators that are derived from this S&P 500 index, namely looking at some of the weekly momentum readings that we've had over the past couple of weeks. We note that the movement here that has moved back from that high at 3220 down to really more normalized trading levels on the chart, with the weekly OBOS reading just around the midpoint, just around neutral level at just 7% overbought as of the trading through last Friday. But that also led to an interesting switch there on that weekly momentum, moving back into negative for the first time in a few weeks, right, Will?
Yeah, Ian, that's right. And I think you said a key word there being underlying, meaning we've had a very aggressive yet directional ascent from those March lows. And while doing so, there's been no absence of volatility, but there's certainly been some underlying tensions and or underlying rip currents beneath the waves, I'll say. And one of those being, as we just alluded to, is this momentum, we'll say supplemental variable that we're going to address here. And that is looking at the 1 week moving average versus the 5 week moving average for the S&P 500. This will turn negative when the 1 week moving average moves below the 5 week moving average, and vice versa. And note that the blue text on the platform across means that we can click and it'll pop up a window. And when we click on this negative 1 week, it'll pop up a new tab for us as we've preloaded, and it'll give us our historical rundown of positive and weekly flips and or negative weeks of momentum. So we know this most recent negative week came after an extended period of positive weekly momentum. Again, a very aggressive directional ascent. And again, the point here is just that supplemental variable telling us that there are some underlying tensions and some underlying rip currents underneath the surface. One other place that we will look at, more of a supplemental front to digest kind of what's going on beneath the surface, we like to reference our bullish percents, right? So I've preloaded here BP SPX. You can also navigate to this on the platform under asset allocation and then technical indicator report, and you'll just need to change it for indices. BP SPX here again as a refresher, telling us the percentage of stocks in the New York Stock Exchange, or excuse me, not New York Stock Exchange, S&P 500 that are currently on point and figure buy signals. Today, we note this ticking down to 48%, and I believe intraday this has moved lower. So point being, about less than half of securities in the S&P 500 have returned to sell signals. Now, that said, coupling that, the negative weekly momentum flip, the number of securities that are not on point and figure buy signals anymore on their trend. Keep in mind when looking with a bit broader picture, keeping in mind the amount of volatility that we've had. To do that, we can look at two places, and I'll start with one, and then Ian will take over for the second part. And one of them is using the same universe for the S&P 500. We're going to look at what percentage are still in a positive trend. So although on a sell signal, how many are still above their bullish support lines? So to do so, we're going to use the PT SPX to get at that. And again, found under a similar location, asset allocation, technical indicator report, if doing so yourself. So PT SPX, as we loaded here, is telling us the percentage of stocks in the S&P 500 that are in a positive trend and or above their bullish support lines. So note here, almost 3/4 of names in the S&P 500 are still above their trend line. So that is hope. That is a good sign to see that a large majority of names are more or less continuing higher, despite the near-term weakness that we've seen via bullish percent moving to sell signals and or that weekly momentum flip for the index as a whole. But nonetheless, 74% reading is actually pretty similar to our equity core reading. And if Ian, you want to touch on that, I think that would be relevant as well.
Yeah, absolutely. And as Will mentioned here with these positive trend charts, as well as the BP charts, I mean, those are, as Will said, focused on the individual underlying securities beneath the index, right? And so while, as Will said, I mean, the 74% is still relatively high. We can look back at the history of it, see that it's a pretty high reading. And this chart has a tendency to stay at relatively elevated levels for a long period of time. So while the reversal down from that 82% down to 76, continuing a little bit lower there on Friday down to 74, isn't the best sign to see stocks moving back into negative trends within the S&P 500. It's still a relatively high reading. And another area we see some pretty similar movement, but on a quite different indicator, as Will said, is that U.S. equity core percent rank on the asset class group scores page. So instead of looking at the underlying stocks, this is now taking a look at the funds that might follow their follow indexes similar to the S&P 500, specifically looking at this asset class group scores page for the rankings of the 135 different groups that we track here on this page. One of those groups you can see at a current rank of 32nd is going to be the S&P 500 index funds group. And so simply what we're doing here is taking all funds that we would classify as within the S&P 500 index funds territory there, group them together, average their fund scores, which goes from 0 to 6, 0 being the worst and 6 being the best, average all their fund scores together and gives us a current fund score that we see at 4.02. We're then going to rank that group relative to the rest of the 135 really investable areas that you could potentially invest in from all the different asset classes. You can see a variety that are going to be represented here at the top end of the rankings specifically, but we use that S&P 500 index funds group as that what we call our core equity percentile representative to really say, okay, how much of out of your total investable universe, how much is the core equity market beating? How much is that S&P 500 index funds group beating? And we saw that reading actually back off a little bit over the past few days, down to most recent reading through trading on Friday of 76%. Which actually marks its lowest reading since April 3rd of this year. So right as we were starting to come out of that market bottom, which occurred for the S&P 500 on March 23rd, we saw the percentile rank spike up pretty quickly there from reading below 60%. and then cooled off slightly at the beginning of April with the volatility we saw to 75, and then continued higher from there. So again, in a similar fashion in the PT charts, definitely this is still quite a high reading relative to historical timeframes. Beating over 75% of your investable universe at the end of the day is definitely still a positive sign. Just one thing to keep in mind that we are seeing that reading back off a little bit there. So will definitely be a place to continue to monitor as we head down the second half of the year. In looking at areas that have caused some of this group movement, as I mentioned right when we came to this page, we see a pretty wide variety of groups up at the top end of these rankings, with 32 groups now possessing a fund score north of 4.0, or as we would call blue sky zone. So those more favorable groups relative to the rest of the field. And actually over half of these groups are actually going to be in the fixed income space. So it's definitely an interesting pairing to see some of your more growth focused equity, like we see there with the S&P 500, the internet, biotech up at the top end, technology, healthcare all up there as well, followed by a lot of the more defensively minded areas like you see there with fixed income. And that does make sense given the continued uncertainty that we're seeing going on in at least the broader domestic equity markets, leading to some continued strength here on the fixed income side. But another group that we've seen rise in strength here recently has been the precious metals area, which is one of the groups that we classify here as an individual domestic equity sector, but it's moved up pretty substantially here in the rankings over the past few weeks with a current fund score of 4.39 and a very strong group score direction there of 2.02, with places that actually, I believe, in the top 10 score directions out of all the groups that we track here on this asset class group scores platform. So we can see as well that, I mean, even though it has a strong fund score, strong score direction, the group on average is still in relatively actionable territory as well, at an average percent overbought, oversold reading of just south of 30%. So still in relatively normalized trading ranges, but definitely seeing some continued follow through for the group as a whole and for some of the individual funds within that group, many of which are going to be looking at the recent strength in gold. One of the tickers we've been using to track the gold movement here recently is one of the larger funds there, the Spider Gold Trust ETF, ticker GLD, that we have on the platform, which moved higher last week to give a triple top breakout there at 176, marking its third consecutive buy signal and a new multi-year high. So definitely a chart that is indicative of that kind of continued follow through we've seen for the precious metal space. Very nice looking chart, really. We have near-term support offered at 158, again, 3 consecutive buy signals, trading well above that longer-term bullish support line. And again, we see it's in relatively actionable territory with a weekly overbought, oversold reading of only 40%. Strong fund score there of 4.38. So definitely a place to continue to look at for those that are maybe feeling a little bit uncertain there themselves, taking a look at some of these other more alternative style areas that might have a little bit more defensive posture. Haven't seen as much movement over the past few months here. This could definitely be one place to keep an eye out for as we look towards the month of July here, Will. And with that, I think that wraps up most of what we were looking to cover today here, Will. Definitely some interesting movement we see going on to start off the shortened market week. So for all of y'all listening, as you probably know, markets are going to be closed on this Friday due to the 4th of July holiday. So with the 4-day trading week, we'll continue to have some of the media content like this video, as well as a podcast we have coming out there on Wednesday. And any other movement we see going on this week, we'll be sure to bring to your attention through the research, the written research as well, and the daily equity report. But if you have any questions on anything, even though it is a shortened week, we're obviously still definitely around to help out. So never hesitate to give us a call for any questions you might have at 804-320-8511. Or if you'd rather type than talk, you're more than welcome to shoot us an email there at dwa@dorseyright.com. So with that, I want to thank you very much for hopping on here, Will. And as always, it's been a pleasure. And thank everyone very much for joining us here this week. And we look forward to seeing you in the second half of the year.